Hello, dear students. So let us understand about returns in security analysis and portfolio management. So when it comes to investment process, there are two major things like risk and return. Okay. So for today's session, we'll be discussing about return. So introduction to return, types of returns, and third one is return analysis in portfolio management. So what is this return in security analysis? Actual definition is basically return. It has two major types like absolute and relative return. Okay. So absolute is the actual gain or loss made on an investment. Suppose if you are investing on any security, what is the actual gain or actual loss, whatever. Okay. Without comparing it to any benchmark. We are not comparing it, that gain or loss with any benchmarks. So that the actual performance is actually called as actual gain is called as absolute return. On the other side, there is a concept called as relative return. So where it measures the performance of an investment, okay, by its, with certain benchmark like a market index, okay. So you're just comparing its performance. Probably you're gaining or losing, whatever. So you're just comparing that comparison of your performance is actually called as relative return. So its importance, like first one is measuring performance. Yes, we need to know how much that we gained because of this so-and-so security. Okay. So that is a very big thing. And assessing investment success, whereby it evaluates the past performance and future. Okay. For the past year, how much return that we gained because of this security and what is the future, present and also future. Okay. And next one is risk assessment. So where by understanding the risk, okay, by understanding the returns, it literally helps the investors to evaluate the risk. Okay. Only by understanding the returns, we can able to evaluate the level of risk. Okay. For that, regarding risk management and exposure, we can able to get or take a clear decision. Okay. For the near future. And next, so types of return, yes, capital gains and income distributions. Capital is what the investment, and gain is like the appreciation. Okay, capital appreciation or capital gain, both are same. So it refers to the increase in the value of the investment. If you are investing 1 lakh and we are taking a return of 1 lakh 50, there is a capital gain. So over certain period. Okay, so after 1 year, after second year, whatever. So that, and after that period, you will be selling, you can get the chance of selling the asset at a higher price. Okay. And next is what income distribution is something that or payments made to investors from earnings, which is what generated by the investment. So the best example is, dividends from stocks or interest from bonds. Okay. So from stocks, when we need to discuss about return, from stocks, we can able to get the return in the form of dividend. Obviously, on the other hand, if we take bonds, return in the form of interest. Okay. And risk adjusted return. So two ratios. One is Sharpe ratio, another one is Sortino ratio. So where it, Sharpe, it measures the performance of an investment. Okay. Entire investment and what is the risk-free asset from, or that reserve investment by comparing that investment with some risk-free asset. When it comes to Sortino, the variations, what are all the variations of the Sharpe ratio, where that actually differentiates the harmful volatility of the entire investment. Okay, these are all the two major ratios and risk return analysis in portfolio. Like we need to do some calculations over here. One is weighting returns, another one is historical versus expected returns. Okay, so here it is the adjustments of contribution of different assets, okay, to its overall portfolio. So we are just calculating its weightage, stock weightage, bond weightage, okay, debenture weightage. So, and next one is historical or expected. So what is this? It is based on the past performance. So name itself defines the, yes, obviously past performance. And what is the expected thing? Obviously, we have to get higher from the past. So for the past performance, if it is what 1 crore, obviously next thing, expected return, it should be 1.5 crores or 2 crores. It depends upon the scenario. Okay. So next is strategic return management. Again, there are two things like active versus passive strategies. Here, portfolio diversification impacts. Okay. So this, it involves frequent trading to perform the market. Okay. So passive is something that where it aims for matching through minimal trading. Okay. Not for the entire thing, only for minimal trading. And here portfolio diversification, its duty is to reduce the risk by spreading the investments. Okay. So you just know proportion. It's like a proportion, 10 percentage for bonds, 20 percentage for debentures, 15 percentage for stocks. All these things you're just diversifying. Okay. So that is a major task of this diversification. So these are all the different concepts of returns. Thank you.